For the past 2 decades, we've seen farmland valuations appreciate continually across Canada and the prairies, to the point where the average family farm today is sitting on multi-million-dollar asset values. But with that comes several $100,000 in potential tax obligation. Hi, my name is Ryan, one of the financial planners and advisors here at Pellegrini Financial in Red Deer, Alberta. In our 30-plus years in working with farm families, the number one questions have always surrounded around capital gains on farmland, lifetime capital gain exemption. What's it worth? Do I have access to it? Does my spouse? Will my children be able to tap into it? Our role is to understand your situation and know it in detail, to know who owns the land. Is it qualified? If it isn't qualified, what steps can be taken to ensure it becomes qualified, and coordinate that with your other professional advisors, being your accountant or lawyer, and ensuring that we're all on the same page to ensure that we are keeping the most in your pocket versus giving it to Revenue Canada. So we are talking specifically on capital gain taxes, and that came about in the 1972 tax year, so your grandparents in particular would be somewhat familiar with what we refer to as Valuation Day. V-Day value of December 31st, 1971, where capital property from that point forward was going to be subject to a form of tax. Now, capital gain tax is not treated the same as straight income. Capital gain tax is basically broken up into two different components. One, and the first component, is the inclusion rate. That is not a tax rate. The inclusion rate is quite simply, what amount of that capital gain income do I include in my tax return? Now, that inclusion rate has changed up and down through the course of time, and it's actually at where it started originally, which is 50%. So as an example, let's assume we have a capital property sale this past year, and we triggered a $1 million capital gain. So that first 50% of that capital gain ends up being ours, tax-free, straight into our pocket. The second part of that capital gain, and 50%, is now what flows through our tax return. And so we end up with that $500,000 subject to our personal marginal tax rate. Well, obviously at $500,000 of income, you're at the highest marginal rate in Alberta, which today stands at 48%. That is the amount that you're going to pay tax on for those dollars. The capital gain exemption has certainly changed through the course of time. It started at $500,000 way back when. It increased a number of times to one of the more recent budgets where it was increased to $1.25 million per individual. Now, lifetime capital gain exemption kind of flows through your tax return similar to how capital gain income does itself. You actually take that $1.25 million exemption, and 50% of it becomes a $625,000 deduction. That is the actual amount that is going onto your tax return to offset a corresponding $625,000 taxable capital gain. So what does that mean in dollar values to me? Well, it's $625,000 of taxable capital gain income that throws you at the highest marginal tax rate in Alberta, which is 48%. That equates to $300,000 in actual tax savings. $300,000 in your pocket versus Revenue Canada. Now, in all these tax strategies we look at in farm situations, there's always a cost benefit. What's the cost to implement a strategy versus the benefit you might receive? Well, a $300,000 benefit is fairly substantial. You jump through one or two hoops to get that amount into your pocket. Our role as financial planners is to ensure that that does land in your pocket, that you have the right strategy in place to maximize the tax rules that are already in place and the tax savings that are already available to you. Let's make use of them. Now, the key to lifetime capital gain exemption always comes back to qualification. Qualification of farm property. Well, what does that mean? Well, there's basically two sets of rules for qualifying farm property. For any land acquired prior to June 17, 1987, you've actually had to own the farmland for at least 5 years and actively farmed it for at least 5 years. For land acquired after June 17, 1987, you've actually owned the land for at least 2 years, actively farmed it for at least 2 years, and your gross farm revenue had to exceed all other sources of income. So there was an income test. Now, the idea of the income test back in the day was to kind of separate the hobby farmer from the true farmer. Now, the benefit is the fact that those income test years do not have to be back to back, right? You can pick and choose what years work best in your situation to help you qualify that farmland. Like all things in the Tax Act, there's always perceived gray areas in tax legislation. Well, once you understand the rules, maybe it's not so gray. In this situation, we're looking at a family who's maybe farmed for the past 30 years. Mom and dad are getting close to retirement. Lo and behold, the half section across the roadway comes up for sale. It's probably adjacent to their existing land base. Maybe it fills out their full section. And as they always say, they're not making any more of it and probably only comes up for sale once. So they have to go and buy it. Oh, good. Now they continue farming for another year, and at that point they decide to sell the operations and then just rent out the land base for, let's say, another 9 years. At which point, well, they decide to sell the whole land base and finish up. The question arises, does that last half section qualify for lifetime capital gain exemption? Hopefully you paid attention to the video, but the short answer is no, it does not. It does not matter if they've been farmers for 40 years. Each individual land piece on its own has to qualify on its own. Us as financial planners are trying to work through those situations with our farm families to understand those gaps in their tax planning. The value of working with planners like us is we can understand those rules. We can identify those tax planning gaps in advance. And our forward-looking planning is trying to identify those issues. And that's different than backward-looking tax filing. Well, we hope you enjoyed this video. If you have any further questions, leave a comment in the section below. Subscribe, like us, and follow us. Thank you.